The once forgotten GIC is becoming a little bit more attractive because the interest rates are moving higher. In this video, we'll be discussing what a GIC is. We'll be discussing the pros and the cons and whether you should be adding it to your portfolio. But if this is your first time here, my name's Nick. Welcome to Ways to Wealth. Before we get into the video, huge favor, huge ask. If you learn something new, or you get some value out of the video, hit that like button for me. I definitely appreciate that. If you haven't already, please consider hitting the subscribe button and turning the notification bell on. We put out content similar to this every Sunday, so make sure to come back and check it out. With interest rates moving higher in this environment, a GIC is definitely making a little bit more noise. We're hearing a lot more people that are worried about the stock market, worried about cryptocurrency. Look for a place to hide, a safe haven, and we'll discuss why. So a GIC is a guaranteed investment certificate, and this is where you pay a lump sum to lock in for a period of time. And what is that period of time? Could be 1 year all the way through to a 5-year period. So that means not have access to the money and you're getting paid a fixed interest rate. Now, these were not popular before because interest rates were so low. We're better off having this money in a savings account and being able to access it all the time. The availability for liquidity had not become, so important as it is today, where we're seeing interest rates on a 1-year GIC hitting as high as 4%. So people are looking at this and saying, hey, my stock market has gone down 5, 10, 15%. I want to put my money somewhere safe that I don't have to worry about it and I can clip a 4% yield. So that is some of the general framework, and I'll put some links below if you want to do some more research on the topic. But let's go and talk a little bit about why you should consider a GIC. So we'll jump into this Western Financial Group here, and here are 3 important considerations. Can you afford to have your money locked in for a term? As I said, there's different variations of terms, 1 all the way up to 5-year. And what is saying here is basically you need that money in a shorter period, then you would not be smart to lock that in. Do you want a fixed interest rate or a variable interest rate? Now, the GICs have different products, which we will touch on in a bit. For the most part, they do pay a fixed interest rate. So another thing is, do you want regular income for your GICs? Well, for the most part, they pay out that interest payment in a lump sum at the end of the term. But this is obviously a question that you should ask your financial advisor or your bank of choice. So one of the things that we would have to look at is to see if there's any risks. And we see here, your GICs may not keep pace with inflation. Now, this is one of the major important things, as inflation is surrounding the market right now with one of the biggest fears. Inflation is eating away at our purchasing power. And in Canada, that inflation rate is 6, 7, 8% potentially. And what that means is that the interest that you're making back on these GICs might not be enough to cover the inflation rate. So that is probably one of the most important cons right now, is the fact that our inflation is outpacing what these GICs are doing on an interest rate level. I think one of the most important quotes I've heard recently is, it's about return of your capital in this market instead of return on your capital. So to break that down, you want to be bringing money in from the investments that you have, whereas in a previous market, you would like to make money on top of your money that you had invested. So that's more capital gain, more growth stocks. Now it's about the dividends, about the value, about potentially GICs, especially if you don't want the risk of being in the stock market. So GICs with variable interest rate offer no guarantee beyond your principal. So what this means here is, if we jump to this RBC article here, we can see the 3 different types of GICs. We have guaranteed return, This is a fixed interest rate payment over the long run. We have an interest rate linked. So this one will potentially increase as interest rates increase as well. So this could be a potentially good product, especially in this environment where we know interest rates are going to move higher, especially in the short run. Then you have RBC equity linked. This is basically attaching that interest or that variable portion onto what the equity market is doing, what stocks are doing. We know stocks have sold off. This may not be the best product, but if we know that stocks are going to come back in the long run and you want a little bit of risk into a GIC, this is definitely a product that you may want to look into. On the right-hand side here, we see special GIC rates. This shows you that the longer that you keep your money in a GIC, the better the interest rate will be. So we see from 1.8% on a 1 year all the way up 4.5% on a 5-year term. There are some different financial providers out there that are providing a higher interest rate up to 4% on a 1 year. So make sure to do your homework, do your due diligence. You can have these just regularly outside of a registered account. You will pay tax on the interest that is gained. If you keep these in a registered account like a RRSP or a TFSA, the interest will be tax-free. So some other things to take a look at is your GIC will be protected. It's protected by the CDIC for anything up to $100,000. Now, with that being said, we're going to briefly look at something that I've come across in my research a few different times called the GIC ladder. Now, a GIC ladder is an investing strategy for any investor that wants to diversify their GICs. So instead of buying a single GIC, you divide your lump sum into 5 equal parts. With this 5 equal parts, you're going to buy a 1 year, a 2 year, a 3 year, a 4 year, and a 5 year. And the purpose of this strategy is that when one of your GICs matures, it reaches its terms, you could reinvest the money plus the interest into a new 5-year GIC, or you could pull this money out, especially if you need it. So basically what you're doing is you're consistently having this GIC train so that every single year when one renews, you can decide, hey, can I put another 5 year on top of this, or do I need that money in the short run? So this is a strategy that I've seen a bunch of different times. And again, I'll leave some links below if you want to research. My own personal opinion is the biggest risk right now, especially for young investors, is the fact that these GICs are not returning as much as inflation. And when we look back to inflationary times in the 70s, stocks performed better than what GICs perform. So for me, this may not be the best product for me, again, personally. But when we look at somebody who doesn't, want to lose capital, they want to make sure that they're making money on their capital, it could be a good product for them. So let me know down below if you like GICs, if you have GICs in your portfolio. I hope you all have a great week in the markets. Happy trading.